Hello friends, how are you all? In today's video, we are going to revise the IND AS 21 for foreign currency transactions. So, let's get started. And you all know that according to your syllabus, this was an important IND AS, right? And we studied a lot of things in it. Now, I have delivered countless lectures on this topic. I will summarize it in an hour and a half. These are the same notes that I had given you in class. You have it in your copy. Please sit down and open your copy. As I revise for you, keep turning the pages of the copy, okay? When things written in your copy get recalled, you can read in AS after that. So kids, I will start revising now. First of all, in my class, in part 1, what was part number 1? Part 1, video 1, lecture 1, it is the same. It's our first lecture. In the beginning, I had explained concept number 1, which was about coverage. I had told you in the beginning that what all we will read. So I talked about covering two things. First of all, we will learn about foreign currency transactions accounting. And other one, we will read about translation of foreign operations. Foreign currency accounting and foreign operation translation. Then I told you what are these two things. If any entity comes within the scope of the IND AS and it is in India, but they do business with foreign companies that are based in those foreign countries, import of goods, export of goods, any foreign currency loan. So all of this comes under unit 1. These are the part of transactions that how will you do the accounting of imports, exports and loans. But if you have established a business out of the foreign country, we call it a foreign operation. It could be anything like a branch, a subsidiary, an associate, a joint venture. So how would you translate it into Indian currency before consolidation? I will teach that. Main objective of translation was consolidation. We need to read these two things. But it seems like there are two things, but I told you a lot of extra things. Your additional concepts that were given, they all were related to consolidation. The first is the elimination of intra-group transactions between holding and subsidiary. The second is goodwill recognition. Let's say you have a foreign subsidiary. Now tell me, how would you cancel the intercompany's debtor-creditor stock on unrealized profit? Second is there's a foreign subsidiary. How will you deal with its goodwill? Third, how will you deal with the disposal of the foreign operation? There are many things. It looks like there are two concepts, but there were many. As I go forward, I'll keep revising things to you. I have attached class notes. You can continue reading them. Then kids, after teaching this coverage, I had started the second concept, types of currencies. Very important. And the entire lecture, your lecture number 1 was completed in the second concept, okay? I just told you the types of currencies and asked some questions. I didn't do anything else besides this. So, maybe you might remember when I told you about currencies. We had 3 currencies with us. IND AS 21 speaks about 2 kinds of currencies, from which one was reporting currency, one was functional currency, and the other one was foreign currency. Reporting currency, what is called as reporting currency? The currency in which you are preparing your financial statements, your profit and loss, your balance sheet, your cash flow. I will show you screen once, it will be easier for you to get it. Here you go. Reporting currency is that currency. Reporting currency is the currency in which an entity prepares its financial statements. Reporting currency is with which you're preparing your balance sheet, P&L, cash flow statements. Reporting currency is the currency in which the financial statements of a company are prepared and presented. You are in India, and if a company in India presents its balance sheet, P&L, cash flow and notes, in what currency will it present? In rupees, in Indian rupees. You'll give it to the Indian shareholders in Indian rupees, right? If your financial statements are in Indian rupees, then that's your reporting currency. Indian rupee is your reporting currency. The reporting currency is usually the same as where your company is located. The country in which you live and do business. You've opened an institution in Dubai. Currency of Dubai is dirham and the financial statements there will be in dirham. If it's American company, they'll prepare their financial statements in America in US dollars. If it's European company, it'll be made in euros. Your financial statements are prepared in the currency of the country where your company is located. It's your reporting currency. You'll say it's a simple matter, very simple. Then we'll go to functional currency. See, first in the reporting currency is the currency in which financial statements are prepared, all of these things. Generally, the country where we are located, that becomes your reporting currency. For all the Indian entities, the currency is rupees. Everything was written in simple language. Okay, tell me, where will IND AS 21 apply? IND AS 21 will be applied to Indian companies which are listed or have 500 crores net worth. Net worth over 250 crores, sorry. If it's listed or has over 250 crores net worth, okay. Why will any foreign company learn IND AS? So if you're in India and you follow IND AS, then you will make in rupees. But when we read rules, we read it in the standardized language. After discussing reporting currency, we went to the next dangerous concept. I spent a lot of time on this. This was our very important concept, the meaning of functional currency. What is the meaning of functional currency in which you are operating your business? The currency in which the company operates its business is known as the functional currency. The primary economic environment in which you are operating in the company is your functional currency. Now here in our case, there was a misunderstanding and fight, sir, is in India. So in India, if you are doing business, you will do it in Indian currency. If you do business in Indian currency, then that's your functional currency. Reporting currency should be the functional currency. How can both be different? Why are you saying it separately? I had said that our IND AS are IFRS based. They have come from other countries where culture of such countries is very different compared to India. India's culture is completely different, but you'll have to learn the rules. I agree with you 200%. Then your reporting currency should be functional currency. You are doing business in India, you will use rupees, not dollars. Big companies that are operating in India are using rupees, that's their functional currency. But IND AS says no, so let's discuss about it. Reporting currency and functional currency can be different, and I had told you the whole story about my trip to Switzerland. I stopped at the bank and they kept asking me about Swiss francs or euros. I used to give them the card. They used to ask me, would you like to pay in Swiss francs or like to pay in euros? Why? Because Switzerland is also part of Europe, so euros. They also have their local currency, the Swiss franc. The culture there is that they do business in two currencies. I went to Dubai. They asked me in dirham or USD. In India, when you go somewhere, you aren't asked what currency you will pay with, as rupees is the only currency used here. Economic environment outside is completely different. You need to understand the concept. Functional currency is the currency in which you run your business, the currency in which you operate your business. The currency in which your business operates is your functional currency, and it may be different from reporting currency, local currency. So I told you to identify functional currency first. To do this, you need to consider two types of factors, primary factors and secondary factors. I had told you three primary factors. The first factor I told you is to check which currency is used to fix the selling price of your goods. Your goods have a selling price, right? Which currency influences the selling price of your goods? The second factor is you need to check your company's material cost, labor cost and overhead costs. Which currency determines their total amount? Then the third factor is the business that you are running. Check that with which country's competitive forces your business is regulated. These were the three primary factors I told you. Which currency influences the selling price and expenses of your business? What is your competitive force? Which currency is influencing it? And then in the secondary factor, I told you with which currency you are raising your finance in, loan or capital. And the fifth one, I told you when you sell goods and receive money, in which currency do you retain it? I explained these five factors to you. The currency to which these five factors drive, that currency will be your functional currency. I had also given you an example that there is an American holding company which opened a 100% subsidiary in India to do business. The goods come from America. They decide the prices, sell the goods in the Indian market, and the subsidiary collects them. It remits that collection. So then this is just a collection center that you have opened in India. I told you the whole story. Then I asked you a few questions. After telling you about the factor, I gave you two special points. First is when you do practical questions, you have to keep your eyes open, be cautious. First of all, if you are asked what is functional currency, you don't have to think at all. First, you have to find in the question whether there is a point about competitive forces. If you find the competitive forces in your question, and goods of your company are coming from America, selling price is also decided there. It's decided based on the markets there. They come to the Indian market to sell. We don't have any competition here. We have a unique product. If the question has the point about competitive forces, then you need to immediately tell the functional currency. The country with whose competitive forces we are regulating price will be our functional currency. But if the practical question is missing the competitive forces aspect, then there are four factors left. What's the majority out of four? Three. Currency that will be favored by three factors will be the functional currency. Your answer will be based on the competitive forces point which is found. Rest all are useless. But if that point is missing, then from the four remaining factors, we will apply the majority rule and accordingly will find the functional currency. This is a theoretical thing. They had all the questions in the book, in the study material, as I only teach study material. Still kids were saying that study mat isn't exam oriented. All questions are from the study material. I don't ask anything out of that. If you check the study mat, you have 3 or 4 examples given in it that tell you to identify which currency it is. All the examples are from foreign countries and none from Indian currency. When we copy the IFRS, we are applying their ideas here and checking how it works. If you practically talk about it, then we'll use only rupees. But you should know the concept. I'm doing based on that. The concept is less practical here. You should get it according to the theory and concept. So reporting currency is used to prepare your balance sheet, P&L, cash flow statement. Then functional currency is with which you do your business. Third one is foreign currency. If a currency is different from functional currency, then it's your foreign currency. If any currency is different from the functional currency, then it is your foreign currency. So what does this mean? It means if I talk to you practically, I see three currencies. One is reporting, one is your functional currency, and one is foreign currency. First, I will translate the foreign currency to functional currency. Then, I will translate the functional currency to reporting currency. If a company uses all of the three currencies together, then it translates twice. First, they'll bring foreign currency into their functional currency. Then they'll take functional currency into reporting. But if you talk practically, this is rupees and this one is also rupees. This is your USD, so you have to do a single translation. We have to convert American dollar into rupees. I explained all of this to you in class. I'll check it out. It was our functional currency. Functional currency is the currency that you work in its primary economic environment. Normally, the functional currency is the same as where your business is located, the country. Sometimes what happens is an exception occurs. In an exception, the functional currency becomes different from your reporting currency. There are two factors for that: primary factor, secondary factor. Primary 3, secondary 2. Look, now turn the pages of your copy quickly. The first is from where your selling price and your expenses will be influenced. Your competitive forces, from where will it be decided? Those secondary factors were mentioned. How do you raise finances? In which currency you receive your loans? And how do you retain your money? I made you write notes on how to apply these factors. The first point is that when you do practical questions, we will try to get a point about competitive forces. If we get this, then we can ignore all the other factors. Country with whose competitive forces you get a point, that will be your functional currency. Let's say competitive forces point was not found, then you will go by the majority. Currency favored by 3 out of 4 factors will be the answer. Then, I made you do these 4 questions. We did this 4 in class. This was important, very very important. All this has been discussed in class. I made you write the meaning of foreign currency. Here it is. What kind of currency is this that's different from your functional currency? Reporting currencies are your functional currencies. It is your foreign currency. The entire lecture is based on the explanation of currency. And I told you that you will have to memorize these 4 questions. They can appear anytime in the paper. So don't leave the concept of functional currency. Lecture 2 is here. The first lecture is over. Then I came to lecture number 2. I started your definitions from here. Your main end AS that started here. This is concept number 3. It's about important definitions. And I explained 3 definitions to you mainly. I gave 3 main definitions. Check your notes. First, meaning of exchange rate. Second, meaning of monetary items. Lastly, meaning of non-monetary items. I told you these 3 definitions. So the first thing was the meaning of exchange rate. What was the exchange rate? Foreign currency single unit. 1 pound, $1, 1 euro, 1 dirham. The rate at which a unit of foreign currency can be converted into Indian rupees is your exchange rate. Pound is of 110 rupees, the dollar is 90 rupees, euro 95 rupees, the dirham is of 25 rupees. How many rupees you will have to pay if you wanna buy 1 unit of foreign currency is known as exchange rate. And then I told you 2 types of rates, the buying rate and selling rate. The buying rate and the selling rate for all the assets you have in foreign currencies, you have selling rate for them. Whatever liabilities you have in foreign currency, buying rate is applied on it. I have imported and bought the goods from outside. I have to send the payment outside. Payment has to be sent. They're demanding it in their currency. If I imported from China, China's currency is RMB. So the supplier says, send me RMB. I went to the bank. I told them I need RMB. So I should buy RMB at the buying rate. I exported outside the country. I exported. Then they sent me a check in USD. I took the USD to bank and told them to give in rupees. I'm going to sell dollars. Selling rate will be applicable. So all the assets are at selling rate and all the liabilities you have to pay for which you have to buy foreign currency is at buying rate. In India there is a culture, okay? Here the buying rate is high and the selling rate is low. This is how the bank makes money. Buying and selling are never same. You wish to buy a dirham, it's for 25 rupees. If you wish to sell it, will be sold to 22 or 22.5, that's the profit of bank. But I told you something else, that we will not discuss buying and selling. In the whole Ind AS, we will assume that buying and selling are same. Same rate applies to assets and liabilities. This becomes very complicated. You must have read about buying and selling rate in the SFM, but they said in the beginning of the Ind AS, consider it the same. We agree. Now they say you have 4 rates. The exchange rate could be your opening rate, your closing rate. It could be your average rate and can be your actual rate as well. While doing accounting, there's no hassle of buying or selling. The hassle is with opening, closing, average and actual. If I speak practically, then if the buying rate applies to the liabilities, it is of 4 types: opening, closing, average, actual. If I apply selling rate on assets, there are 4 types: opening, closing, average, actual, totally 8 rates. But to understand this, we made buying and selling equal with 4 rates each. We will use all 4 in every place. No question mentioned different rates for assets and liabilities. So we didn't discuss about buying and selling. We discussed about opening rate, closing rate, average and actual rates and their use. I told you the opening exchange rate. The rate of the 1st of April, the rate for the first day of the year is your opening rate. The rate of 31st March, the last date of the year, is your closing rate. Daily rate, you need to do the transaction on 14th of August. So, the rate on 14th of August is your actual rate. I need to make a transaction on September 20. Rate on September 20 is my actual rate. And the transaction on October 15, rate on that date is my actual rate. There are 365 days in a year, so there will be 365 actual rates as RBI announces rates daily. So go on website of RBI, you will get daily rate of every currency. What is the name of the daily rate, actual rate, transaction rate, or the spot rate? The day when you go to do transaction in foreign currency, check rate of that day. You can give any name: daily rate, actual rate, transaction rate, spot rate. Rate for first day of year, opening; for last day, closing. Daily rate is actual support transaction, and one there is average rate. Average. Now here your point depends on that. For what period? For what period do you need average? You need the average for 1 year annual average. So multiply total rate 365. Divided by 365, you will get average. If you need quarterly average, so add the total rate in a quarter and divide it by the number of days. It's 90 days on an average. Add up all the rates for a month and divide the sum by 30, so you will get the monthly average. Have you understood the meaning of average? Take the average of that period for which you want to use. And if we don't use our mind in buying and selling, then exchange rate is of 4 types. 1st April, 31st March, daily rate, and our average rate. Then we discussed why we are studying this, because its application is everywhere. This opening rate, I think it has no use anywhere. This one, which is your average rate, I don't see its use anywhere. For me, there are 2 main rates. One is your closing rate and the other is your daily rate. Your opening rate and your average rate can be helpful in the translation of foreign operations. But if you think foreign currency transactions will be of use, no, it won't be. If you have to do the accounting of foreign currency transactions, so you will need the 2 rates, the closing rate and the daily or the actual rate. Opening and average will be helpful, but it's very limited. We can see in foreign operations. I have already explained you. Exchange rate is 1 unit of foreign currency. 1 unit of foreign currency can be converted into an Indian currency, which is exchange rate. One is buying and other selling. I've done the revision. Go through your copy and turn pages quickly. Look at this. The bank rate is where you can buy the currency because you need to send it abroad and also because you need to make a payment. Buying rate is at which an entity can buy foreign currency for repayment of its liabilities. Selling rate, at which you can sell currency brought from outside. This is applied on assets. But we have stopped the discussion here. Then we divided it into 4 parts: opening, closing, actual and average. I have explained the whole thing to you. This is one definition that we read. Then we read another definition. Meaning of monetary items. Monetary items versus non-monetary items. Concept number 1, coverage. Now coverage has 2 things: translation and transcription. Then I went to concept number 2. How many types of currencies are there? Reporting, functional and foreign. And then definitions of exchange rate. This is third concept. I am referring to monetary items, not non-monetary items. What is monetary item? I said a very simple thing. If any asset or liability. Do you remember if there is any asset or if there is any liability? Fixed in foreign currency. If any receivable or if any payable is fixed in the foreign currency, then it will be a monetary item, okay? And if the arrival of an asset or the departure of a liability is not fixed in foreign currency, then it is your non-monetary item. Fixed payable. Fixed receivable is your monetary, non-fixed is your non-monetary. The student says, sir, I don't understand. So I explained you with an example. For example, foreign currency debtors. You sold goods outside country for 10,000 USD, you will get the same. If you have imported 10,000 USD, so you have to pay. You took a loan for $5 lakhs, so you have to repay it. You issued preference share capital for $5 lakhs, you have to redeem. You have issued debentures in foreign currency, you will have to redeem. Debtor, creditor, loan and debentures. Do you understand? Preference share capital, outstanding expenses, BRBP, you know how much money comes in and goes out. Tell me what is debtor and creditor, you have contract with other person. That's why name of party is coming. From whom you have taken loan, so where two people agree to give and take money, where there is contract, that is monetary item. Okay. So debtors, creditors, loan, BRBP, outstanding expense, preference share capital, debenture. All these are monetary items. Tell me what comes under the non-monetary items whose currency is not fixed, for example inventory, and also you have stock. So it won't be fixed until you sell it. You have fixed PPE, intangible assets. You are currently using it. We will see when we sell it. You have investments. You have shares of some American company. You have purchased in the USD. Nowadays people also invest money in foreign exchange. You have inventory, PP, intangibles, investments. These are non-monetary. Why? Until you sell it, you won't know the price. The day I sell my investment, price will be locked. Price of investments fluctuates daily. I am using assets and will know upon selling. I don't know for how much my factory will be sold. I have fixed inventory's price. I don't know if the customer will agree to pay that amount. I will only come to know when it will be sold. There's no contract in inventory. The day customer buys it, they become debtor, you can call it monetary. Then you asked me why I am doing this bifurcation. It is because the accounting is different for this and it's different for this. Rules for monetary are different from non-monetary. If you made mistake in bifurcation of item, or if you have chosen wrong accounting model, then marks will be deducted. So you should know which item we have to consider. I have told you the whole thing in detail with examples in the class. It's monetary item, which are fixed in foreign currency. That means the inflow and outflow, whether it's receivable or payable. So example was debtor, creditor, loan, pension, gratuity, which you'll give to your employees. Okay. You have to give preference share capital, debenture, some provision that you have prepared in foreign currency. Everyone has read in AS 37. When we make provision, when outflow is probable and we know that money will go. See how many examples are there. Non-monetary, non-fixed, which are not fixed, which have not been fixed yet. We don't know how much money will come in and go. Why assets, inventory, investment, ESC, reserves, equity, share capital? Because you have buyback. There is no guarantee of buyback. Preference share capital is of redeemable nature. You have to pay money back, so it's monetary. It's either redeem at par or premium as written in prospectus. You do not require to buy back the equity share capital, as we will not return the money lifetime because it is an irredeemable capital where no money has to be paid and there is no guarantee or liability. It will be non-fixed, non-monetary item. Okay, then we came at concept number 4. The first concept was on coverage, second was on currency, third was on definition. Now fourth is on accounting. From here we started accounting part for what it was. It was for foreign currency transactions. From here we have started the accounting part. You might remember that we have divided foreign currency transaction in two parts. First, you figure out that whether you are doing accounting of monetary items or non-monetary items. Monetary rules are different, non-monetary rules are different. We have bifurcated this. Then we started discussion on this. Accounting for monetary items. Like discussed, it was divided in two parts. Settlement in same year. You must remember. Please check it in your notebook. Okay, check it. You will find it written in the same format as I am saying. Settlement in the next year. Now we have started the accounting for monetary items. In that we got two concepts, same year and next year. What was it? Same year means the export happened in this financial year and also the collection. Now the balance sheet shows no balance. It was imported in same financial year and repayment was done. Balance sheet does not show any creditors. So when any balance is not visible in the balance sheet, then that settlement is in same year. The balance sheet rule won't work. Import payments, export collections all settled within the same year. And as far as the balance sheet goes, there is no balance of foreign currency. It's zero. So there is no involvement of balance sheet. But when we talk about the settlement in next year, so it has been imported this year, but we will pay it next year. Let's say in the month of March, I imported goods last month and I will make the payment in June. If it's imported in March, then you'll see creditor on 31st March as payment will be next year. If it was exported in March and in February, then collection will be in next year. So you will see debtors in the balance sheet. So this becomes settlement in next year. I have told you two concepts. So when we did concept of same year, so let's say same year's USD is 10,000. I'm taking example of export. The rate is 60 rupees on 1st May and the rate is 63 rupees on 1st June. This is my sell date and this is my collection date. Sales were made this year, collections also came this year. This is called as settlement in same year. A very simple accounting. First is initial recognition. It means to pass the first entry. I had told you a uniform concept on daily rate. Let's head over to actual rate. If you are passing entry of 1st May, so on the rate of 1st May, and if you are doing on 1st June, so on the rate of 1st June. This is our initial recognition. This is our settlement. So we have passed first entry 60 into 10,000, which is on 6 lakhs rupees, and entered as debtor account debit to sale. Foreign currency debtor account debit to sales. You can check this presentation from copy. I have entered the sale of 6 lakhs rupees. I got the money after 1 month. On that day the rate was 63 rupees. I will get dollars and take it to bank. Bank says I am giving 63. Now I have 630 in my account. So now I will pass entry bank account debit 630 to debtor 6 lakhs. 30,000 extra has come. This is change gain and this will go to profit and loss. There is no difference in dollar. It is 10,000. But where is the fluctuation coming? It is coming in the rate. Monetary item, fixed payable, fixed receivable. So 10,000 is 10,000 only. First it was 60, now 63. So fluctuation is there. Ind AS clearly says all these fluctuations will go in P&L. If rate increases, your collection will increase. If it goes from 63 to 59, you lose 10,000. Then also we put it in P&L. If you get 590 for 6 lakhs, it is loss, and 630 for 6 lakhs, then profit, because we have to take exchange G and exchange L and put in P&L. This is called settlement in same year. This year sale and collection. In 2 steps the work is done. First step, initial and second settlement. Take the difference between two and put in P&L. I am talking about monetary items. I am talking about fixed items. Now let's take another example. On 1st of February, the rate is 60 rupees. It's my sales. On 1st of June, the rate is 63. These are my collection, and on 31st March, X1 is my balance sheet, and the rate is 62 rupees. Sale happened in February, collection in June, but balance sheet date came in between. When balance sheet date arrives, you have to give a presentation, but how? You have passed an entry on 1st Feb foreign currency debtors account debit to sale. Initial recognition at actual rate with 60 rupees on $10,000, so pass entry on 6 lakhs. We passed entry. Now the collection comes in June, but 31st March is in between. So this 31st March is your balance sheet date. The debtors will be visible on balance sheet. 10,000 USD. It's of 1 lakh rupees. Here in AS21 comes in between. What does it say? It's a monetary item. Do you know that $10,000 will come? This is a monetary item. This is mandatory to show monetary item in the balance sheet date at the closing rate for true and fair presentation. All the monetary items like suppose debtors, creditors, loans, anything that you have are monetary. You have to report balance sheet date on the closing rate. I have checked the closing rate for 31st March is 62. The valuation of my debtors is increasing as it was at 16, now it's 62, a gain of 20,000. So I need to pass an entry that debtors account debit 20,000 Y, 10,000 into 2. How did you get to 62 minus 60? So 2 exchange game will go in P&L 20,000 rupees. In my balance sheet, debtors are not of 6 but of 620 lakhs. Again they said, sir, you have completely ignored prudence. Prudence says don't record expected gain in the books, but you are asking us to do it. I am not making you do that. It's in the AS. The true and fair presentation of yours is considered above the prudence. When you know $10,000 will come and its rate is 62, so it should show that. If currency is not fixed, we won't show. If currency is fixed, the rate is 62, then show profit 20,000. Leave prudence aside, focus on the presentation. The first step is initial recognition on the actual rate. The second step is balance sheet at closing rate. Now debtors are of 620. Now I came on 1st of June, collection is there. What is the rate at time of collection? 63. So you shouldn't compare 63 with 60. Compare 63 with 62. Why? It was already 60. We have made it 62. We made the gain. Now take it to 63. So compare initial with balance sheet and balance sheet with settlement. So this was a simple process. We do this in Inter also. Let's pass the entry. Bank account debit 630. 2 debtors 620 and 2 exchange gain 10,000 rupees will go in P&L. Alright. And behind this, they have provided another logic that we do not do accounting on cash basis but on accrual basis. So last year's exchange gain and loss remained in last year. For this year, it's showing in this year. It's working on accrual and not on cash basis. If you want to make 60 to 63 and collect a gain of 30,000, so it accounts on cash basis. First make 60 to 62, then 62 to 63. Suppose someone says it was 60, then it became 59, then it became 63. So dollars are still 10,000. This is an example of export. So then what you will do? When the concept is given to you, then what difference does it make to us that what is the amount? It's 6 lakhs. This is 590 and this is 630. So no problem. There is a loss of 10,000 rupees. We will put it in P&L on 31st March. Balance sheet date. This is the sale date and let's say this is the collection date. We don't care if it is profit or loss, calculate the difference and put in P&L. But when we went to do the collection, we had gain of 40,000. Last year there was loss of 10,000. This year you have gain of 40. So overall it is 30,000. If loss of 10,000 is booked and gain of 40,000, overall it is 30,000. So 6 into 6 makes 30. But on the accrual basis, the last year's story ended in last year and this year's story in this year. Overall, you will see the same impact, but it will be on step basis. So I have explained you accounting of monetary items in 3 steps. Look, I will show this to you. We had started this concept of foreign currency transactions, which covered 2 units, monetary items and non-monetary items. We started monetary items same year and next year. In same year, there were 2 steps. 2 steps in same year, initial and settlement. This is same year. First step is initial, do it in actual rate. Second step, settlement, do this also at actual rate and put the difference between these two in P&L. But if you go to the next year, there are 3 steps and the balance sheet will come in between. Here we have done some examples, small examples, conceptual example. You have to read it by yourself from notebook. Look, this is situation 2. It's your next year's concept. The first step is actual rate. The second step is balance sheet date. And here is the closing rate. And the difference between the both is P and L. I will repeat, difference is P and L. Okay. Third step is settlement, the actual rate. Then calculate the difference between step 2 and step 3. P and L. You have the example. See the example that you are given. We took loans example. Then second lecture got over and third lecture began. Third lecture starts with the exports example. Then we did question 11 from study maths test your knowledge. Then question 12 from the same was done. As per some opinions, my classes are not exam oriented because I do not cover study math. It's not clear where I teach from. It is often said that my content is 400 hours long. I take them at a slow pace. If other person is not teaching you but giving shortcuts, what's my fault in that? Now a kid doesn't want to study but wants to become a chartered accountant, a reputed professional. What can I do about it? Tell me. Serious aspirants will respect me, but what can I do about others who are not? No sir, I don't have time. How will you become CA then? If you want to earn money or respect in life, or if you want to reach somewhere, then this is the right time. Don't waste your energy. This is the time to study. Are you getting it? Big dreams have a price to pay for. You have to sacrifice a lot. It's not that easy. You will have to make sacrifices. It's not a world of films. Even the film actors shoot around the clock. They travel continuously before they can see their families and look at the cricketers. Sachin Tendulkar didn't see his family for the 25 years he played cricket. Sometimes their match happens during Diwali or Holi. Their practice runs all the time. They don't know what is happening in their family. You have to leave everything to become Bharat Ratna. Remember that if you want to gain something, you have to lose something in return. If you think that you will become a CA without any hard work, you won't be able to do anything. If you want to do something, pick up the books today itself. Or after becoming CA, because you will have to do it sooner or later. Books are our best companions, and if you develop the habit of reading now, you will not regret it later in future. So, the habits you get used to continue in future. Becoming CA is not important, you just have to give exams and you will become one. What after this? How far you want to go in life matters. You must be thinking that I am always saying things like these in class. It's my experience. I've lived through it. If I were a new YouTube teacher, maybe you wouldn't listen to me. I have gained numerous lessons from life. I'm about to retire and leave after another 2 or 4 years. Mark my words and learn this lesson. If you want something in life, you have to lose something. You can't get everything. Let go of small pleasures and you will get great pleasures. What are small pleasures? Partying with friends, sleeping, being active on social media. What are the great pleasures? It's to have a good bank balance throughout life, or to be a well respected person in the society. To be respected in front of people, only your knowledge will get you there. Knowledge is very powerful. I got all I have because of my knowledge. The budding CS ask for my blessings, all due to knowledge. If you gather competence, the world will automatically start respecting you. When you say to me, no sir, I don't have time, then for me, all of these are just your excuses. I have taught this question. It's from study material. Don't take my words personally, it's for your benefit. I never spoke in classes, only here because I got this chance. 12th question is done and 16th was the homework. Then I came in non-monetary. It is a very great concept. Non-monetary accounting is an excellent concept to study. So, non-monetary items, okay? I had mentioned there are only two steps in it, first and second. There's no such thing as same year or next year in it. There is no same or next year's concept, as in no balance sheets concept. First step is initial and the second is settlement. No need of balance sheet. Did you understand? So, you have one property, plant, equipment. Leave it, I'm changing example. So, the company bought a property, okay, for appreciation in Dubai. Okay, and we have made the payment of 1 lakh dirhams for this. 1 lakh dirhams, and the rate was 25 rupees. We paid 25 lakhs. Now we have made an entry and passed it. PPE account debit to bank 25 lakhs. But I know that my property is in Dubai. And I also know the value of properties in Dubai keeps changing. If this property were in India, there would be no fluctuation. But this property is in Dubai, there'll be price difference. I bought it for 1 lakh dirhams. I made the payment at the rate of rupees 25 lakhs and kept it. This is my first step. Now come to the second step, settlement. And after 5 years, I sold the property I bought in Dubai. Now students, you all will be like, sir, 5 balance sheets would have been issued in 5 years. It should be in the balance sheet too. Why aren't you applying the closing rate? I am trying to tell you that non-monetary items don't have closing rates. The non-monetary items rate will remain the same, the rate at which you bought it. There's no need to show it at the closing rate. Just show by doing acquisition and then wait for the sale, meaning the settlement. I went to sell it and sold it for 1,10,000 dirhams. I made a profit of 10,000 dirhams. So when I sold this, it becomes 27.5 lakh rupees, right? So 10 multiplied by 25, my rate was also 27 rupees. Rates 27. Rate and price both have gone up. Do you understand this? So this is your settlement, okay? There's no need of balance sheets concept in this. Now what will be its accounting? Let me explain. I'll pass the entry bank account debit 1,10,000 dirham into 27. I'll get 29,70,000 rupees after multiplying 110 with 27. Then I will write to PPE, I bought it for 25 lakh rupees. Now write fair value gain. It will go to P&L. To fair value gain. You had invested 1 lakh and received 1,10,000. The value of your property has increased from 1 lakh dirhams to 110. So there's fair value gain of 10,000 dirham. At the rate of 25 rupees, let's assume it's 2.5 lakh rupees. Then you have an exchange gain. Both gain are different and will be calculated separately. The price difference, that is 110 for 1 lakh, is a fair value gain, and rupees 25, which became 27, is an exchange gain. How to do this? Look. Multiply 110 by 2 rupees and 27 by 25. So you have exchange gain of 220. Tally the entry and check. 25 plus 2 plus 2 is 29. Was there any balance sheet in between? For non-monetary items, 2 points are worth noting. First, the day you buy them and keep them. Record them at the acquisition rate of that day. No changes should be made in balance sheet. When selling it, you need to calculate the fair value gain and loss and exchange gain and loss at the time of settlement. So break it into two parts. And I am explaining this breakup. And I have given examples of the breakup that I am explaining. I'll elaborate it a bit further. Here you go. Non-monetary items include inventory. and the investments and PPE, and it includes ECE and reserves as well. I had mentioned two steps for non-monetary items, the initial and the settlement. I asked to ignore balance sheet. We'll leave it at that. I'll tell something new. We are still talking about non-monetary. I discussed this concept extensively. Let's say I bought an investment, okay? Bought in shares. But of an American companies, I bought shares of an American company and I bought them in USD. Alright, I bought shares of Apple and I made the payment in USD. I am living in India. I can buy American companies shares, right? So, I have made a payment of 10,000 USD and the rate on that day was, let's say it's 80 rupees. So, I passed an entry. Investment account debit. To bank, rupees 8 lakhs. 80 into 10,000. This is my step 1. Now the second step. In second step, we have the balance sheet. But in AS 21 says this is non-monetary item. For balance sheet date, no need to show it on the closing rate. Very nice. But then 109 came in. 21 gives me the exemption to leave it at 8 lakhs. I don't need to show non-monetary items. We will see fair value gain and exchange gain when I'll sell it. But 109 says that equity shares are with you, so balance sheet valuation is mandatory. 109 is applied on it and it's asking for valuation on the balance sheet date. But this is the inventory, so in AS2 says cost or the NRV, whichever is lower. PP says that it will use a re-evaluation model. So if your non-monetary item is seeking valuation from you on balance sheet date in its original Ind AS, then 21 also tells you the process of how these fluctuations are recorded. Here I explained the breakup of the exchange and fair value. It's possible, right? 21 says to forget non-monetary, but 109 says to do the valuation. So what did we do next? Under 109, we checked the balance sheet date to find out what the fair value is today. Okay, clear? So it was found that the shares you bought for 10,000 USD were of 10,200 USD on the balance sheet date. You're making a profit of $200. Great. And when you check the rate, you found out that the current rate is going on at 81 rupees. You have got two benefits. 10,000 has become $10,200 and the rate of 80 has become 81 rupees. Hence two gains. So if a non-monetary item's valuation is done in original Ind AS, whether it is 2 or 109 or whether it is 16 or 38, you should know process for valuation of non-monetary items. I told you two steps. Step 1. Start with 10,200 minus 10,000. Let's do it. Into 80. Don't look at this rate. First look at how much your dollar has appreciated. Here I am taking the actual rate, okay? The one I initially recorded. But I am taking the difference of value or price here. Clear? This is my fair value. This is my carrying amount and this is my actual rate. I need to increase the investment of $10,000 by 200. I had invested rupees 10,200, then 200 into 80, so rupees 16,000 would be fair value gain. Then step 2, as I told, was investment has become 10,200. You turned 10,000 into 10,200 because of fair value gain of $200. Now with this price, minus 80 from 81, exchange gain will be 10,200. These were two steps. First, calculate fair value gain, which is fair value minus carrying amount multiplied by actual rate. Then find exchange fluctuation by taking rates difference. This is fair values difference. This is exchange gains or exchange rates difference. I had told you two steps. Both are gain, so 26,200 has increased in total. To increase investment's value, first you will pass the entry. Investment account debit 26,200, okay? So fair value gain as well as to exchange gain will go to P&L. It is 16,000, it is 10,200. So current balance sheet shows an investment of 8,26,200 and not of 8 lakhs. You can check if 10,200 into 81 is giving 8,26,000. So this is how I taught you to break up and taught you how to segregate. Got it? This whole process was explained to you in 2 steps. Take any example like the example of stocks or inventory. You bought an inventory for 10,000 USD. The rate was 80 rupees, but it became 9,800 USD when the balance sheet came and your rate was 82. Out of cost and NRV has lower value. The valuation will be based on it. First, calculate the fair value loss, also called as valuation loss. So subtract 9,800 from 10,000 into 80. Look here, you can clearly see that you have a loss of 16,000 rupees. So this is your fair value loss. Now coming to the exchange. 9,800 multiplied by 82 minus 80. You will see gain here. There's gain of 19,600. So overall there will be a gain of 36 rupees. There is a loss and a gain. We have covered all accounting and also past entries. Look here. This is non-monetary. It means that the presentation of non-monetary items at balance sheet date will be the same rate at which it was acquired. In this, accounting for non-monetary items is similar to accounting for monetary items except accounting for balance sheet date, because we don't apply the closing rate on balance sheet date. I explained basics first, then I told you some helpful things like exception. Look here. Your principle will change if you need to do valuation of balance sheet date. Clear? And the non-monetary items are measured at fair value at balance sheet date. We can consider closing rate. It can be taken if we go by fair value. 2 steps were mentioned, first and second. First, find fair value change. First, take fair value, deduct initial recognition and take actual rate. Then find out the exchange fluctuation. I've explained this entire working. It is written stepwise in your notes. I have also given examples. Look. This is example 1 which I was explaining. Here's example 2. It became 8,800 from 10,000. It's inventory's example. You are losing $1,200. 1,200 times 60 is 72,000. You lost $72,000. But there's a gain of 2 rupees. 60 becomes 62. So it's a gain of 17,600. Here's 2 different entries in 2 steps, then we passed entries. This is the valuation loss, this is exchange. Everything is in your notes, check them out. Okay, after this, here's the third example. Okay, then fourth example is separate for PPE, investment and inventory each. I have given separate example for everything. Then question 10 was done from study mat, test your knowledge. It is a very important question. This question from study mat is an exam oriented question. Next, after question number 10, it was a big question. Question 20 was homework. Then we come to lecture number 4. This is part number 4. We started with the 5th concept of foreign operations. First, I taught foreign operations definition. I told that if you establish a business outside of India, then it is your foreign operation. You can establish this branch in any form, like subsidiary, associate, or joint venture. So, any business outside of India is a foreign operation, and you can establish it in any form. Why are we reading in AS 21? the foreign operation will have to be consolidated in India. Are you getting it? If it's a branch, then the head office will consolidate it, and if it's a subsidiary, then the holding company will consolidate it in India. If it's an associate, then the investor will consolidate it in Ind AS 28. If it's a joint venture, then we will consolidate it under 28 or 111. Okay, students? Consolidation of any foreign operation you establish outside of India has to be in India. Therefore, it will be in Indian rupees. Foreign operations' trial balance is in foreign currency. So, you need to translate the trial balance into Indian currency before consolidation. You can consolidate it after the trial balance is translated into Indian currency. In this, I didn't teach you consolidation. You only know what you did in 110, 28 and 111, right, students? In this, I had just explained to you how to translate the trial balance from foreign currency to Indian currency. And it had some translation rules in it as well that were to be followed. For example, you are preparing a trial balance. Alright. We are translating from US dollars to Indian rupees, euros to Indian rupees, and pounds to Indian rupees because you need to create consolidations report in India. So, we have one debit and one credit. Earlier in the class, I asked to check for foreign operations assets. So, whether it is goodwill or PP or intangible, whatever it is. If assets are ready, then apply closing rate. Whatever liabilities he has, apply closing rate. So, now you don't have to check the monetary and non-monetary aspects of the assets of foreign operations, no matter what. Don't check the monetary and non-monetary at the time of translation of foreign operations, just simple rate, closing rate. Okay, after that, whatever expenses it may have and also whatever income it may have, apply average rate on all. Okay, so the share capital that it has, the reserve that it has, and the surplus that it has. Two parts of reserves. First is pre-acquisition and second is post-acquisition. This is on date of acquisition. It happens later. Which rate on it? Date of acquisition rate. What was the rate of the shares on the day you bought them? This is also the date of acquisition rate. This is your average rate. Post-acquisition profits are those we earned later. If later, then average rate. We took the total. The difference that came. There has to be a difference between the total of the debit side and the credit side. You are putting different rates, so we called it FCTR. Foreign Currency Translation Reserve. And we showed the FCTR to the OCI. Foreign operations assets and liabilities at closing rate. Income and expenses at average rate. Capital and pre-acquisition profit at date of acquisition rate. Post-acquisition profit at the average rate. We calculated the difference to find FCTR and showed it in OCI. I told the entire working to you. See? Foreign operation is that operation which we are running outside India, which could be a subsidiary also. It can be an associate, a joint venture, or a branch. You need to consolidate it in India. So you will have to translate it for that. When we do translation, we have to read the rules. See here, each and every word is written. Closing on assets, closing on liabilities, average on income, average on expenses, actual on share capital, actual average. Find the difference to get FCTR and show in OCI. Then a student asked me that whether FCTR is classified as recyclable or non-recyclable. I had said that this is recyclable. It will remain unchanged for as long as foreign operations continue. And as soon as you sell the foreign operations, we put FCTR in P&L. It's all written as well. If entity disposes of the investment in foreign operation, FCTR is transferred to P&L. Then we did question number 19, very important. You were taught through translation. See, this is the translation done. See, we did the translation. Then we did reconciliation and the reason was told in Hindi. You should revise the question. This is question number 15. This might be of some RTP or MTP. First, we identified which items were monetary and which were non-monetary. Then we showed the translation. See, such wonderful questions. Students with recordings of the old course have a separate question bank for RTP and MTP. Those who have new recordings, we provided you with all the MTP RTP till the point where you have purchased them. We have added those in it and the rest you will get on Telegram. We move to the next concept. Concept number 6 on loans. We are discussing long-term borrowings. I had told you something about this. If any entity has taken long-term loans in foreign currency while living in India, so we get two cases here. First, let's check that if this long-term borrowing is initiated prior to the applicability of Ind AS 21 or after it. Clear? If any entity has a foreign currency loan, then first check that when this foreign currency loan was taken. When we took the foreign currency loan, were we subject to Ind AS or AS at that point of time? So, if a loan is old, AS 11 was applicable to us and now we have transitioned to Ind AS. Did you get I had taken a loan during AS times? Now we are subject to Ind AS. I am subjecting this loan that this loan is from before the Ind AS application. You must be applying AS 11. In AS 11, it's paragraph 46A. Who is the one who tells you the treatment for this? So, this Ind AS 21 says that it is permissible to implement the guidance of 46A. You are fully entitled to proceed with the application of the AS 11 accounting. You are not required to follow Ind AS 21. If you have a loan from the period when AS were in effect and you have come to Ind AS, you can still continue the AS accounting. We ask why and it's told that go and refer 101. So what's in the 101? It's the first time adoption of Ind AS. Some exemptions are discussed there. So this is stated by 101. If a loan is not from the time of AS, the application of Ind AS has already been applied to it, and if you take a loan after that, then Ind AS 21 will take action and you will not get a chance to apply AS 11. So if a loan is after the application of Ind AS, then apply Ind AS 21. Now what does Ind AS 21 say? It tells monetary item. Add the closing rate to each balance sheet, send it to P&L and make the payment. Just as you did accounting earlier, continue in the same way. 46A isn't needed at all. If you took the inter classes from me, the inter notebook should be with you. I have noted 46A in that for your reference if you want. But it's not needed as it's not useful. You will never be asked questions on 46A. It's just for knowledge. I explained you all that, students. Okay, then we did question number 14. Lecture 5 has come. See, question 14 is from your study mat. We did practical questions. Okay, right? So we will move on to concept number 7 now as we go along. What is concept number 7 about? Elimination of intra-group transactions. This is very important. It's an important concept. One is holding and other is a foreign subsidiary. Okay, all understood. I will not discuss CFS with you right now. I won't be discussing translation with you now, nor about foreign operations. I am rewinding it to clarify. This is a holding. It's a foreign subsidiary based in India. This is in the USA. Okay, understood? Holding sold the goods to it. Sold goods. So, the foreign currency debtors are shown in its books now. Because entry will pass foreign subsidiary to sale. They are debtors until the money arrives. If money arrives, we will eliminate it, okay? These foreign currency debtors in the form of subsidiary are there in the balance sheet date. I'm not talking about CFS or foreign operations. I am just saying that I exported to a company, made it a debtor and put in the balance sheet. This is your monetary item now. You will show this on the balance sheet date at the closing rate. If we show the closing rate, there will be fluctuation, it will go to P&L. So I am referring SFS here. Stand alone financial statement of holding as per Ind AS 21. Suppose holding sold the goods to subsidiary or someone else, the monetary item appears on the balance sheet with fluctuation affecting the P&L. Nothing new is being said. Okay, what happened now? Its balance sheet has debtors. So its balance sheet will have creditors too. When its balance sheet has creditors, now it's time for CFS. They will be eliminated. Eliminate his debtors and its creditors. Ind AS 21 says that when you create CFS, you will cancel each other's dues. Cancel the debtors and creditor, do it. But this monetary item evaluation that you did inside the SFS and the exchange fluctuation we got will not be eliminated. The holding company sold goods to subsidiary and made it debtor. He is creating his SFS with Ind AS 21, reporting the monitoring items and extracting exchange fluctuation and putting it in his P&L and brought it to closing rate. So now it's time to make the CFS. I translated the foreign operations. I translated and brought it into my books. Debtors and creditors are in front of us. Ind AS 21 says, cut what needs to be cut. But the exchange fluctuation you recorded in the SFS, as per Ind AS 21, do not touch it. You are cancelling each other's balances. It has nothing to do with the exchange fluctuation. Do what needs to be done in the CFS. The SFS exchange fluctuation will be there. Second point is that holding sold the goods to subsidiaries, that too at a profit. Ind AS 110 says, if you make profit among yourselves, then you will cancel the unrealized profit, which is called stock reserve. We will check downstream upstream, so Ind AS 21 allows to create stock reserves. But this has nothing to do with your Ind AS 21 exchange fluctuation. It's because of 110, means that cancel the debtor creditor, cancel the stock of the stock reserve, do whatever. This has nothing to do with your Ind AS 21. No impact on exchange fluctuations, it will remain the same. How do you eliminate it? You can cancel the mutual balance, but the exchange fluctuations are in single party books. How will they be eliminated? Remember, one more thing was told. The balance of FCTR that you have, FCTR. While eliminating your intra-group transactions, it will not affect that. It will be there. So you are eliminating it from balance. Do debtor creditor, do BRBP, create stock reserve, do what you are doing, do what 110 says. But neither will the FCTR of the Ind AS 21 be impacted, nor the fluctuation recorded in SFS. And I have covered the questions related to this for you in the past. Your copy has notes written in it, please check. They are attached on top of the screen, read it. Pause and see. Look, the 8th question was done. Very, very important. On intragroup transaction. See, even entries are passed too. If anyone needs to revise the 8th question, they can do it from the screen or do it by the class book, as you need to. 21st and 5th were given in homework, then 2 questions were discussed in class, then we moved on to concept number 8. It was computation of goodwill and its translation. That was a good point. So, you have taken control of a foreign company while sitting in India and took 80% of the shares, and an Indian company took over the control of a foreign company. So this is business combination. It will be subject to IND AS 103. IND AS 103 says that net assets debit, 2 PCs, 2 NCIs and difference goodwill. So here IND AS says a thing that if you buy control in a foreign company, so this initial recognition with regard to 103 will be done in foreign currency first. This goodwill calculation will be done in foreign currency. If you are investing in a foreign company sitting in India and controlling it, and you call it a business combination, then the goodwill that arises from that company will be in foreign currency. When goodwill is in foreign currency, then it will be translated at the closing rate. You understand? If you have invested in a foreign company, then 103 will be applicable in foreign currency. Goodwill will be in foreign currency. When we translate foreign operation into India, then closing rate will automatically be applied on goodwill because closing rate applies to all other assets and liabilities. I told this. The closing rate will apply to foreign operations assets including goodwill, which is part of these assets. Let me tell you one more thing. Goodwill was calculated in foreign currency using the closing rate. Remember the concept of bargain purchase? Net assets debit, 2 PCs, 2 NCIs, not goodwill, but this bargain purchase is coming and you send it to the capital reserve. Capital reserve will be in foreign currency since it's a foreign company. So this capital reserve that you have taken out in foreign currency is a kind of pre-acquisition profit. This rate would be based on the acquisition date. Goodwill will convert to assets covering the closing rate, but if capital reserve comes, so then our pre-acquisition date of acquisition rate will be enforced. I have already told you all this. See here, as per the Ind AS 21, goodwill in a foreign subsidiary shall be computed in a foreign currency first. Find goodwill, then translate it to the closing rate because all the assets and liabilities convert at the closing rate. Next, if the capital reserve comes in on the date of acquisition in foreign subsidiary, then you know which rate to apply on the pre-acquisition profit. Then we also had questions on it. Question number 13, there was both goodwill and elimination. You should revise it, dear. Okay. We have also past entries. Okay then. Then the last concept came up. Concept 9, disposal of a foreign operation. When we dispose of any foreign operation, the FCTR will go to P&L. Remember I told you this. Let's say you have a foreign subsidiary. You sold it. Subsidiary will have to be recognized. When you recognize the subsidiary, you pass net assets debiting entry to the bank, to NCI, goodwill debit. Now I have to dispose of the foreign operation. Dispose of foreign operation. So what next? I will turn everything upside down. If I sell it, then money will come to my bank account. NCI debit, remove this as well. Remove 2 net assets. Remove 2 goodwill. Remove FCTR also. Remove FCTR and what else? And remove post-acquisition profits as well. Because we may have added the post-acquisition profits to our reserves. What will be the difference? Let's see. First, the FCTR balance goes automatically to P&L. The rest is disposal profit loss. It's all is accumulated in P&L. See this entry here. Remove FCTR, take the bank, the selling price, remove NCI. Remove the post-acquisition reserves, remove the assets, remove the goodwill, put the difference in P&L. Then the 18th question was done about disposal. I have also solved questions. Entry pass is done and the question from your study mat. Okay. Then we have thank you. And best of luck is here too. My name is here. And your Ind AS 21 is revised. Reading the questions is your job. Working hard is your job. I can just teach you and help you revise. I can put in some effort. But ultimately everything is in your hands. Do you want to be a hero or a zero? It's on you. I agree, destiny plays a very big role in life. Situations and circumstances play a very big role, students. Every student's circumstances are not the same. Some children are struggling with the financial conditions in their family. Some children are struggling with health conditions in their families. Their parents or others in the home may also have problems. Some students are fighting with themselves. Everything is fine, they just can't study. But let me tell you, the fight is with all. This student does not have financial issues but is struggling with himself and lacks motivation to study. Those who want to study are not getting the conditions to study. Yes, there is fight. You must fight to survive, students, and only then you will move forward in life. If a student faces no troubles in life, then they are truly a blessing from God. He should study anyway. Your brain is good, your financial condition is good, there is no problem in your home either. So, what would be the most favorable condition for you? Can you tell me? I was born into a good family and my father was a wealthy man. He passed away 2 years ago. He had a lot of money. We were in good condition. I arrived in Delhi staying in Lakshmi Nagar hostels. The food and rooms were poor and staying was not good. But the only thing that I had in my mind was to become a CA. I wanted to achieve something on my own without others attributing it to my father. I can't describe the condition of Lakshmi Nagar at that time. Food was the biggest drawback there. But we survived it and today we have become something. You will have to fight. Thank you so much. Take care. Bye bye. Love you all. In the next video, we will revise IND AS 8 of accounting policies. It should be revised within 25 minutes since it's small.